Well, good afternoon, everybody. Welcome to a hot July day here in Cleveland, Ohio. I'm sure it's hot where everyone is. We're well into the 90s and summer is in mid-form. Um, with that, before we get kicked off for our July market insights, let's hear from the compliance department.
Hey, Todd.
Okay, hey guys, hey
Hi,
Rich,
Todd.
hey Gavin. Well, everyone loves consistency, so let's keep with the theme here that we've always done, and let's do a recap of our June call. Whoever wants to kick it off.
Yeah, I'll kick it off. The change that we noticed really from June into July is that Quad 2 reflation, risk on environment remains in the lead. Behind that has been kind of a battle, a tug of war, if you will, between Quad 1 and Quad 3, which one of those is risk on, Quad 1, and Quad 3 is risk off. Quad 1 has gained the lead underneath Quad 2 again, so we would say this is a risk-on environment. What has changed is the signals that add up to make that happen have gotten a little less conclusive on Quad 2. I guess you would say it's a little less conviction than we had in June. So that's really the biggest change. Rich, do you have anything to add on that?
No, just to clarify that, when conviction drops, it means some things that we typically look at are neutral, and neutral doesn't really tell us anything one way or the other. Doesn't matter to us whether something is bullish or bearish. Both are a signal. And it doesn't imply that just because things are bullish, that is also bullish for equities. For example, you don't want volatility to be bullish. You don't want currency volatility to be bullish. Those are risk-off signs. So we just feel like we get a clearer read when we try to observe behavior across all these global asset markets and characterize it as to whether it best represents Quad 1, 2, 3, or 4. It helps to have more signals. And neutral signals are kind of a way of saying those markets are still trying to make up their mind. And until they do, that doesn't really provide us any further clarity. So conviction is just a measure of how many total signals are signaling something.
Okay. Well, that's a good update. And so let's kind of, pivot to the topic we want to discuss today. Jamie Dimon came out yesterday and said the environment, he's never seen a better environment for banks. We've talked about this in the past about deregulation, and banks can often be the lifeblood and are a good indicator of maybe how the economy or how stocks will perform. So give us some color on what he said yesterday and how that would apply to perhaps signals or where we think things are going here for the rest of the summer.
I guess first we have to say we're not giving any specific advice, on any particular sector. That's more of a, individualized thing. But aside from that, we have been saying for quite a while to expect bank deregulation. And that traces back to the fact there is a massive supply-demand imbalance in the Treasury market. In order to roll over existing debt, to term out debt that the Treasury previously issued in T-bills, and to finance current deficits. There's just an imbalance of buyers, for that. Central banks are not buying. In fact, they're, reducing. Commercial banks are full and aren't buying anymore. And the incremental supply over the last few years has been taken down almost entirely by private sector buyers who buy because they want to. Commercial banks and central banks buy because they have to. They're implementing monetary policy or they're complying with regulations. And there are limits as to how much the private sector will take down. And our thought all along is the way the Treasury is going to be able to do this is by loosening restrictions on banks that allow them to increase the amount of Treasury holdings And in order to do that, is there going to be some other kind of deregulation or re-regulation that allows them to go out and make loans? Keep in mind, in the post QE era, the Fed prints bank reserves out of thin air to buy treasuries to expand their balance sheet, and then they turn around and they pay banks an interest rate to sit on those reserves and not lend them out. So part of it would be freeing up the capital, or freeing up the reserves so that banks could buy treasuries, but then also go out and make loans. And that potentially would be a positive backdrop, not just for, the banks themselves, but, the broader economy.
Right. Kevin, anything to add to that?
I would just say, because I'm more in the weeds on the actual earnings this week, they're coming out and everything looks okay so far for the banks. To your point, Todd, it's a quad 2 in the lead, like we started with and mentioned, and that would make sense with banks to the points that Rich is making. So that adds up. The other thing I might just add about the lower conviction score this month, and I'd be curious, Rich, to know what you think about this, but there are a lot of kind of big question marks coming up. Earnings look like they should be good, but the bar for the S&P earnings coming up is set high. So investors want to know how that's going to go. You have the midterm elections coming up. You have Kevin Warsh, at the helm now starting. Maybe Rich, you have some thoughts on that, but maybe all of those big question marks also have not a risk off, not a necessarily negative impulse in the market, but maybe that's why the conviction score has backed down a little bit. Maybe we want to see how some of this is going to resolve. I don't know. What do you think about that, Rich?
Well, I'll just add a couple things from the testimony. Warsh is testifying in front of House Financial Services Committee, part of their annual requirement to comply with the I think it's the Humphrey-Hawkins Act. Based on his answers to some questions, I think it reinforces the idea that we're going to get some sizable bank re-regulation or deregulation for the time being until they come up with a better metric. I think all eyes are going to be on the trimmed mean PCE deflator as the Fed's preferred inflation gauge. There were comments about forward-looking market data, prices, signals, etc., to help guide the Fed. Keep in mind the inflation and employment metrics that they track are two of the most lagging components of the business cycle. By the time they've registered on the Fed's radar, it's too late, which is why they're always a day late and a dollar short. Not only does Warsh have a connection to the legendary investor Stan Druckenmiller, so does Besson. And that's kind of the big thing that Druckenmiller always preaches, is that the best information, the best economist resides inside of these market signals. So to the extent that the Fed does incorporate some of those, I mean, that's essentially what we're doing with our approach. To the extent the Fed tries to do that, it could improve monetary policy. The other thing is he seems to be very aware of this K-shaped economy that we've been talking about for, I don't know how long, a year, 2 years, maybe longer, where the top part of the K is doing extremely well. The bottom part of the K is struggling. So when the Fed raises interest rates, the top part of the K are companies and individuals with large cash balances that are happy that they're getting paid a good rate on their cash, and they don't have debt. The bottom part of the K has debt, where the high interest rates hurt them, or people or companies that are in interest sensitive sectors of the economy get hurt. There's a monetary policy component that underlies that, where it's the distortions caused by monetary policy that create that separation. to the extent that Warsh wants to address that. I would think that's very good news for society in general, but it could be risk for, stock market investors. It would imply that the Fed put is quite a bit lower than, where people have gotten accustomed to. So, we're going to be very interested in the formation of these task forces, who leads them, what their findings are going to be. And collectively, they hold a lot of potential, but the devil's going to be in the details. So we'll be, focused on that primarily, between now and the end of the year.
Well, that's a lot to digest, lots moving, new Fed chair, a lot going on. The Iran conflict still hangs out there. So, it's always kind of a wait and see. So, well, I appreciate the time. Good update as
It might be a
usual.
good opportunity to plug the fact that, this is why we believe, so strongly in adaptive risk management, as opposed to buy and hold. With all this stuff in flux, I can't imagine, someone pre-committing to a fixed allocation, assuming risk and return are constant, when you have all these things that, are undergoing big change.
Right. I agree. Our philosophy should pay off. So, well, again, thanks, guys. Appreciate the time, and we'll see how things turn out. And we'll be back in August, towards the end of summer here, and pick up things there. Have a
Sounds
great
good.
day,
Take
guys.
care, Todd. Bye, everyone.
Take care.
See you, Gav.